It is virtually impossible to have a conversation about African oil and gas without discussing commodity value behaviors in the last 18 months. The massive fallout in oil, natural gas, and consequently LNG prices does not only impact oil companies, but in Africa it has had significant economic and political implications for host governments throughout the continent. Since June 2014, when oil prices held relatively steadily above $100, the dive began and did not stop until January of this year, when they bottomed out below $30. WTI levels recovered quickly in the next couple of months before stabilizing at the $40 plus trading level we see today. The price decline has produced a parallel plunge in oil and gas exploration. The African rig count, which indicates drilling activity, went down to 88 in March 2016, a 40% difference over 2 years before. Natural gas prices have also suffered, with Henry Hub spot prices declining below $2 in March for the first time since the 1990s. Long-term LNG projects, whose contracts are linked to the price of crude oil, haven't performed well either, slumping about 50% in the last year. Spot LNG markets, once a refuge for gas exporters, have suffered a more drastic fate, declining 60% from a record $19.70 per million BTUs in February 2014. The commodity slump has been especially punishing on African producers whose economies depend on oil revenues to drive growth. Oil constitutes nearly all exports for many of these countries. These severe losses in revenue are very difficult for governments to absorb. While production has remained steady, governments and their private partners have been forced to make painful adjustments. In May 2016, the IMF reported that annual growth in sub-Saharan Africa would fall to 3% in 2016. That's as low as it has been for the last 15 years and nearly half the rate we have seen for most of the last decade. In a scenario where the oil price goes down from $100 to $60 to below $40, many countries see deterioration in their external position. To give you an idea of the true impact, a $40 barrel equates to GDP losses, relative to $100 per barrel, of 7.6% for Nigeria, almost 20% for Angola, and nearly 35% for Equatorial Guinea. In fact, the less economically diversified a country is, the more affected it has been by the slump. It looks like oil and gas prices are on a long march to recovery, but while markets slowly rebound, issues like regulatory uncertainty and fiscal terms have moved up the list of important concerns and have given oil companies strong negotiating leverage. The percentage of government share for sub-Saharan African countries from onshore, shelf, and deepwater projects is higher across the board than the global average. To preserve investor interest and improve global perceptions, host governments are increasingly under pressure to make competitive contractual offers.